Good morning, Emily.
Good morning, Dan.
What are the topics of the week?
Wow, no joke.
I am a humorless person after getting home at midnight.
Okay, fair enough. The topics this week are the bank on yourself strategy, first lien HELOCs, and recovering from bankruptcy.
Welcome to the Science of Wealth, where we discuss the science behind financial planning and the art of learning and applying it. Oh, goody, we're talking about two things that can help make you bankrupt and then how to survive from bankruptcy. What a lovely narrative sequence.
Yeah, a really uplifting week. I wanted you to be excited when you get back from Chicago, so I lined up some good ones for you.
Well, you are just doing me all the favors in the world. Okay. Banking on yourself, family bank strategy. Hit me. What's the question here? What do we want to talk about?
So I was at an event a couple weeks ago, and someone brought this up to me, and they were very excited about it. And I was like, "Oh, okay, tell me more about this family banking strategy that you are getting involved in." And the way that she was telling me about it was very much like a recited sales pitch. I could tell she was kind of parroting that she'd heard from someone else, which I was kind of tips me off. So I was like, okay, I want to look this up a little bit more. And the more I looked into it, I thought, this is kind of a sales pitch. So I thought we'd talk about that today. But first of all, why don't you explain to people what is the family bank strategy then? What is she looking at?
Let me even take the strategy out of it for a second and just sort of give you a hypothetical. So imagine that you are told that you can borrow your own money from yourself and pay interest to yourself, and that will make you wealthier. Does that pass the smell test at face value?
Not really, not from my perspective.
Okay, so we're on the right track here. So now imagine that I say, okay, the way that you're going to do this is you're going to buy life insurance. And if we did this properly, you're going to buy very little life insurance, ideally. And in so doing, we are then going to put as much of our money into the life insurance as we possibly can. So, in the same way that I might say I'm going to put as much of my money into a brokerage account or into a savings account or a CD or something, I'm going to put a bunch of money into this life insurance policy specifically. And then I'm going to borrow money from the insurance company using my money I put into the life insurance policy as collateral. And this is a part where we often hear just an outright lie or misrepresentation. We're going to be told that if I borrow money from the life insurance company, I'll have to pay it back with interest, but that I'll get the interest. This is not true. What is actually happening is my cash value is still invested in the life insurance policy in the first place, and the life insurance company is just using it as collateral, but the interest I'm paying is not going back into my policy, it's going back to the insurance company. Does that sound particularly special or incredible or amazing in any way that you can think of?
If you're the insurance company, sure.
Well, and the funny thing is most insurance companies are not the ones running out there teaching agents to sell life insurance policies this way, because life insurance companies are not really in the lending business. Lending from life insurance policies is more about accessing, you know, money inside the policy without letting it lapse or having to cancel it to get the money out. So it's more of a liquidity provision for life insurance companies than it is a big money maker for life insurance companies.
Okay. So how are so is this allowed to advertise it this way? I looked at the website of someone in particular who was selling this just for reference, and there's all these claims in the website of infinite growth potential, and they really emphasize like your legacy and generational wealth, and this is how the Rockefellers do it, and things like that. All of these, supposedly very impressive things. Can they say things like that, or is this just straight fraud?
It's not fraud. It is completely legal. However, it is, I'll say, grossly unethical and is using a enormous loophole in how the laws around how life insurance is sold and marketed are. So, by law, if you are an appointed life insurance agent who is a producer of an insurance company, Okay, when you sell a specific policy, right, so if I want to sell a Mutual of Omaha policy or a Securian policy or a Nationwide policy, by law I am required to only use the produced illustration and sales materials created by compliance and marketing and so on from that insurance company to sell that policy. And I even sign things, and the client signs things saying that that is all we relied upon in the sale of this policy or the creation of this policy. The thing that then is done to skirt that is what agents who want to sell policies like this will do is they will say, I am giving some arguably completely unrelated education to the public. I am giving a seminar, I'm doing a webinar, I'm talking to people at a networking event, and I am just educating them about a strategy. And if they should so be interested in that strategy, then after a certain point when they are already essentially sold on the idea, I will then present to them a compliant illustration from an insurance company and say that that is the only thing I have used to sell that very specific policy. So it's not illegal, it's not fraud, but we are really stretching the technical definition of what is education versus what is sales or marketing or material used in the process of selling a policy.
Okay. Well, is this ever a good idea, even for someone who's just, say, incredibly wealthy? They've maxed out every other savings method and they're kind of drawn to this, okay, legacy for my great grandchildren thing, like the Rockefellers. Does that ever make sense for them, or still no?
Well, first of all, the Rockefellers thing is hilarious because you will hear that example from life insurance agents all the time. Like, well, the Rockefellers had cash value life insurance. No shit, they were the equivalent of like Jeff Bezos today. You think Jeff Bezos doesn't have life insurance? I mean, like, of course they had it. Of course, Walt Disney had it. Of course, banks own key man life insurance on their executives. Like, you'll hear all these examples like, well, this is what like super rich people do. Yeah, but it's not how they make their money or build wealth. They do it because they need life insurance. Right? And then they don't like bank on it or do any of this other absurd crap. So you'll hear lots and lots of different ways that this gets marketed. You'll hear it called bank on yourself, infinite banking. You'll hear different variations of this where they'll talk about something called like hyperfunding. Hyperfunding being borrowing money from the policy to then pay more premiums back into the policy, and then hoping that the interest rate you get on your policy exceeds the interest costs of the loan you took on the policy. Like, there's all sorts of these like super fascinating, ultra marketed, ultra branded strategies for whole life insurance, universal life insurance, all sorts of stuff. And all of it is just to sell life insurance. That's all it is. There are, I think, a handful of people who are really genuine experts in the crafting of complex permanent life insurance policies who actually know what they're doing, who can actually produce some interesting results or value with well-crafted life insurance policies. But the ratio of, pardon my French, stupid people who've had a life insurance license and a TikTok account for 7 minutes trying to sell these strategies without knowing anything about the product to the number of people who actually know what they're doing and actually know how to like structure a product with a specific purpose is like 1,000 to 1. I have been hearing about infinite banking, bank on yourself, all this sort of stuff since before I was a financial planner. It didn't make sense then. It doesn't make sense now, but I cannot begin to even like guesstimate the number of influencers, online people, random people who just got their insurance license, who became members of the Chamber of Commerce 7 minutes ago, whatever, who have come to me and told me about this strategy. Like, I'm actually amazed it's taken 2 years for somebody to try to pitch that idea to you, because it's just this stupid idea that'll never die. But it sounds super good when it's presented without all the actual underlying facts presented, and it's just garbage. It always has been. It always will be.
So it goes back to the old tried and true. If it sounds too good to be true, it probably is.
Well, there's that, and then there's also just like there are other versions of this that are much more logical, right? So take the exact same idea, putting a bunch of your money into a particular thing and then borrowing against it. Okay, why don't you do a securities-backed credit line through your brokerage, right? This is actually what ultra wealthy people do. Is Jeff Bezos has several $billion of Amazon stock and goes to his brokerage and says, "Hi, I'll use my Amazon stock as collateral. I'd like to borrow $10 million to buy a yacht." And they are happy to give him $10 million and he pays interest. And if ever for some reason the Amazon stock starts to go down, he'll have to sell some of it to cover the loan. But otherwise, the bank is securitized and is a secured creditor against the value of that loan. And nobody is telling the lie that he's not paying interest to the bank. He's just happy to avoid the income tax or the capital gains taxes that would come from selling his stock to spend the $10 million instead of borrowing it. Like, there's perfectly legitimate common uses of this, right? You're like, your mortgage is a collateralized loan against the value of your home. But a bunch of life insurance agents trying to figure out how to get more people to buy more policies or to, dump more of their life savings into life insurance because that's how they get paid, figured out a long time ago that if you make something completely mundane sound super sexy and point to people like the Rockefellers and Walt Disney, that some poor people will buy into it thinking that it is a true secret of the rich, when in fact it's this dumb, mundane thing the rich occasionally use just to have life insurance, let alone to actually borrow against it or try to overfund it for some reason.
Well, I guess that sums it up pretty well. That paints a very accurate picture.
Yeah. And I mean, here's just another example of this. If this was such a great idea, like truly the world's best idea, you would think the insurance companies themselves would have it all over the place. Like, it would be on front and center of every single application or the illustration materials. Like, did you know that if you put extra money into your policy, we'll lend it back to you and then you can pay interest and yada, yada. The insurance companies are not interested in any of this stuff because, again, they're not really in the lending business. They are in the life insurance premium collection business.
Yeah. And I think we've talked about that several times in the podcast and all things like that. So I won't dig into that anymore, but there's plenty of references out there if people are interested. Oh, let's see. But, okay, I have another topic now that I have a bunch of questions about. So here's my smooth transition to number 2. I was also having a conversation a couple weeks ago with somebody. They called me and they're like, very excited. And they're like, okay, I'm buying another house, very impromptu. I'm buying a larger house. My wife is pregnant and we're going to have more children. I'm so excited I found this house. And I'm like, great, good for you. What's going on here? And he says, yeah, and I haven't sold our existing house. And I know enough about his situation to kind of wonder, okay, how are you affording house number 2? House number 1 hasn't sold yet. And he said, don't worry. I'm going to do a first lien HELOC. I figured it out. It's all under control. So Dan, first of all, what is a first lien HELOC?
Oh boy. I'm actually going to approach this the same way that I approached the last question. We're just going to take all the terminology out of it. I'm just going to describe the idea here. Has it ever occurred to you, let's say if you bought a house in, 2020 or 2019 or 2021 when interest rates were super low, right, like 3%, would you ever think to yourself, you know what I should do? I should convert my mortgage from a super low fixed rate to a variable rate mortgage. So I should lose my secured low interest rate and instead switch to a rate that is based on the current rates and can go up or down with the condition of current rates, and that has a shorter payoff timeline. And I should convert my mortgage to that, and then on top of that, I should borrow more money against the equity in my mortgage to purchase other real estate. And in so doing, now have my mortgage on my first home and my second home both be variable rate mortgages that I potentially will not be able to pay off in the allotted time. Does that seem like a good strategy up front?
Not really when you say it like that.
Yeah. So, I mean, a first lien HELOC, is different than a second lien HELOC. What most people think of when they talk about home equity lines of credit is a second lien HELOC. And a second lien HELOC is saying, hey, I've owned my house 5-10 years. I want to renovate the bathroom. I want to redo the kitchen. It's always the kitchen for some reason. But, I want to borrow some money to redo my kitchen. And I'm going to borrow money and I'm going to use my house as collateral for that loan. And then I'm going to spend that money on renovating the kitchen, bathroom, whatever it is. And when they do that, they then technically have 2 loans. The mortgage is in the first lien position. So you still have your fixed, 3.5%, 4%, 6%, whatever percent mortgage. And then you have this secondary mortgage, right? The HELOC, the second lien HELOC, which is behind the first mortgage in the liquidation order, which is why it's the second lien, not the first lien, right? So if you're ever foreclosed upon or lose your house, whatever it is, the first lien bank is going to get its money first, and then the second lien bank will get its money second if there's any money left over from that sale or that foreclosure. So then, because of that, you have to not only pay your mortgage on the second lien HELOC, you also have to pay the second lien HELOCs, both principal and interest down. Some banks will let you do just interest only payments and not actually pay the principal on the second lien HELOC down. But generally speaking, you have to pay both the mortgage and the HELOC. In the first lien thing, you're converting your conventional mortgage entirely into a HELOC. And then because it's a completely flexible, do whatever you want sort of thing, you can then use that to purchase other real estate. Now, when you do that, you now run the risk, of course, that you cannot keep your payments up with the variable rates. You've also now tied your ownership to two properties instead of one property. And now you're sort of stuck with both. You have a variable rate, you've lost your guaranteed fixed rate. And because of the sort of fluid nature of how these HELOCs work, you can find yourself in a situation where you're making payment after payment after payment after payment, and you're never actually really putting a dent in the principal anymore. Because unlike your 30-year mortgage, which is on an amortization schedule to get you paid off, HELOCs can essentially be sort of redone over and over and over again, such that you're kind of always just paying interest, or you're paying some interest and some principal, but then the interest rate goes up, so then you go back to paying just the interest and so on. So essentially you're just taking on an enormous amount of sort of, I'll call it credit card debt in a loose sense, that's securitized by your first home. And then you may choose to buy another home or do something else with it. You don't have to buy another home with it, but in so doing, you've essentially converted your fixed rate mortgage that you're going to pay off in 15 or 30 years into an enormous credit card.
Yikes. Okay, well, this person I was speaking to specifically, I know they were actually very excited about this variable rate. He was like, this is so exciting for me. I'm a business owner, and so he kind of has lumpy income depending what time of year it is and when their business is fluctuating. So this is so exciting. If business is slow for a couple of months, I don't have to have that fixed mortgage payment like you do with a traditional mortgage. I can, just pay the interest, like you said, and not pay towards the principal. And he says, don't worry. When I have a good few months in the business, then I'll just pay off, a huge chunk of that principal and interest to make up for the times where I didn't. That's his plan.
And that is not a bad plan given the requisite discipline, financial means, and so on to approach it. And I'm not going to say that this individual does or doesn't have that discipline. I'm not here to pass that sort of judgment. What I'm going to point out is the observation that your primary residence historically is not a very good investment. Just from a rate of return standpoint, net of taxes, net of insurance, net of maintenance and upkeep costs, and then your actual mortgage or borrowing costs, most primary residences essentially grow at the rate of inflation when you net all those costs out, which is not to say then that you're not able to build wealth, right? One of the things that's been pointed out about our financial system being so heavily based around home ownership and mortgages is that it is a forced savings mechanism. And you can later tap into that savings mechanism through reverse mortgages, selling your home and downsizing. Like there are things that buying a home gives you that renting does not. But the challenge is that math is often pretty questionable or pretty dubious, even on a conventional 30-year 6% mortgage. So take all the systematic, you're forced to save, you're forced to put money into this property to build equity in it, math out of the equation, and then turn around and go, okay, well, now we're taking all the forced mechanisms out of play, right? We're making it optional and discretionary instead of default and de facto. And in so doing, we're taking on additional risk that the interest rate is increasing. Like even based on how they described it to you and you just described it to us, right? I'm very excited about the variable interest rate. The variable interest rate is not the same thing as the fact that you don't have to pay down the principal necessarily, right? The variable interest rate is the substantial risk that one day interest rates will be increased by the Fed. Maybe not today, tomorrow, later this year, but at any point between now and when your debt is actually paid off, right? So call it 30 years to infinity, okay? At some point that the economy will have a downturn, we'll cut rates, or the inflation will kick up a lot, and then we'll raise rates a lot. Like your payment is going to be going up and down and all over the place just to support the interest part of it. And then we've taken down the principal payment part of it to the point where you're not required to pay off the loan in any material sense unless you actually sell the property or lose the property. And so in that particular context, right, this idea or this enthusiasm that we're going to get ahead by having a lot more control about our lumpy income, et cetera, really is just sort of rationalizing a very high risk decision. It's not to say that it couldn't work, wouldn't work. It's not to say that we don't want it to work for this individual, but it is a high risk decision that we are justifying. And here's the trick, right? The only reason you would do something like this to purchase another home is because you were not going to be eligible for a mortgage on the other home. And then you have to ask the question, well, okay, banks are in the business of lending money and taking in interest payments to make a profit. So if they're not willing to lend you the money under a conventional mortgage scheme, what does that say about their beliefs about your risk profile and the financial feasibility of your ability to pay both mortgages or pay for this new mortgage? It doesn't say a lot of good things. So it's something where, again, we would wish this person luck, but functionally, this is probably not a good idea for almost anybody.
All right. That pretty much sums it up. That's about what I thought.
You are right. Congratulations.
Yes, I wish I had better news for that person, but either way, here comes transition time again, Dan. Now let's talk about life after bankruptcy. For example, if your first lien HELOC went poorly. I think on here we've talked before about the basics of bankruptcy, what different versions of it are and things like that, the facts. But I don't think we've really gone over, okay, let's say you did have to file for bankruptcy. Terrible, but now you need to start over. How do you start to rebuild again and dig yourself out of that hole that you are now in after filing bankruptcy?
The funny thing about filing bankruptcy is that once it's over, nothing bad happens instantaneously. Like you have this black mark on your financial history. You're not going to be able to buy a house or borrow money or get a good credit card or anything for a long time. But the world keeps spinning and life goes on after bankruptcy. I think the first thing you have to realize is that really the most materially negative impact of the bankruptcy is what it does to your credit, right? You essentially had to say, I borrowed more than I could afford. I have to tap out. And bear in mind, a lot of bankruptcy in the United States is medical debt related. Often we sort of go to people who spent too much money on their credit cards or lost their jobs and lost their house. But a lot of people just had an accident or an incident that was way more expensive than they could handle. It wasn't poor decision making on their part or irresponsibility. And so with that, when we get past the curve of just getting bankrupt, the biggest impact is just, hey, your credit's not going to be good for a long time. So you can kind of make one of two decisions. You can either do everything in your power to live without credit, and I think that makes more sense for somebody who has, you know, arrived at a bankruptcy because of the uncommon but still occurring, financial irresponsibility, mismanagement sort of scenario. But if you were, an otherwise upstanding citizen until you got into that car accident and didn't have good health insurance, and suddenly you ended up with $200,000 in medical bills sort of scenario, then in that case, I think you have to try to start building credit deliberately, but cautiously. You're going to be able to get a credit card with a ultra low, credit score, but the credit card rate is going to be incredibly high. You're not going to get any of the perks or benefits, etc. And so you're going to want to be ultra cautious in how you have that card, use that card to build your credit back up, to show a good payment history, to show that you're not delinquent, right? To show that you actually spend too much on it and so on, to help build your credit. Because it's going to take about a decade to get your credit score recovered after something like a bankruptcy, because it will take no less than 7 years for the bankruptcy to come off of your history in the first place. And in the meantime, that whole 7 year run, every credit decision you make, borrowing money for a car loan, trying to get a mortgage, trying to get a credit card, taking out student loans, every single thing you possibly want to borrow for is going to be at worse terms than it would have been otherwise, because you are a high risk borrower. And so not only do you need to be careful about borrowing money for any reason, you also need to be careful about not finding yourself in the same debt spiral that you were previously in for whatever reason it was.
Sure. But after, in that 10-year period, you still can get a mortgage and auto loan and stuff just at worse rates? Or is there ever a scenario where you're kind of getting rejected for these loans and you can't actually get them at all?
You could get a mortgage, even a year or two after bankruptcy. It's not that it's impossible, it's that you're going to pay exorbitant interest costs. And so it becomes a thing of, okay, I can buy a house today, but I'm going to have like a 9% mortgage rate or 10% mortgage rate, which at today's home prices is going to mean I'm going to be paying an insane amount of money towards my interest, let alone getting my principal down. Or I can, take out a credit card or two, over time, pay for my Netflix on them, put them on auto pay, never pay any interest, just be really cautious with them, and spend the next, 5, 6, 7 years really building my credit back up. And 7 or 8 years out, when my credit is essentially clean in a general sense, then I can borrow at much more normal rates.
So you're kind of, uh, you're stuck renting and doing things like that for a period of time just because it makes more sense, even though you could get a loan for these different things.
Well, you're, I mean, potentially stuck renting, or you're going to need to buy a lot less house for it to be affordable. I mean, I don't want to tell anybody they can or can't do something based on those terms and conditions. You know, we have clients who were running a relatively successful online, product business, who then essentially almost overnight got essentially bankrupted, not by anything they did, but by the fact that their main product distribution platform essentially changed the rules and costs and so on distribution, and suddenly they had an enormous amount of credit card debt, a lot of inventory they couldn't sell, and we're finding ourselves suddenly going bankrupt for no reason. But they were able to, for example, keep their house as part of that, keep their cars as part of that. You know, they're not in that business anymore. They had to go back to getting regular W-2 jobs. So it's not to say that you're like suddenly alienated or ostracized from society and you can never have anything ever again. It's just that, borrowing costs for the next decade are going to be very high, meaning the cost of borrowing is not only more expensive on a dollar for dollar basis, but also that runs the risk that you find yourself in the same debt spiral as before. So it's just about being really conscientious and conscious about what you are borrowing for, and if you absolutely need to borrow for it in that next 5 to 7 year period, or if you can live without it.
Sure. Well, let's talk a little bit more about preventing bankruptcy again, if possible. Of course, with medical debt and certain things like that, maybe you couldn't have done much about it other than have better health insurance if you could afford it. But what other things should people be putting in place if they have already filed bankruptcy once?
I mean, bankruptcy is the byproduct almost always of just either, again, accidents or things that were not foreseen, or occasionally systematically bad behavior. So when it comes to the, unprepared for the unforeseen, people don't want to be insurance poor, right? But foregoing disability insurance, foregoing high quality health insurance, foregoing adequate liability insurance. We've talked about all of these things before on the podcast, so I won't beat them to death here. But I mean, like if you are a spouse, a parent, whatever the case is, you need life insurance, right? If you are a working person who depends on their income, or your household depends on your income, your spouse's income, everybody's income in the household, you need to have disability insurance, right? If you are driving a car around in Boulder County, guess what? There's a bunch of $100,000 plus cars in the roads in Boulder County. And if you've got a bare state minimum, 25,000 per person, 50,000 per property per accident aggregate liability policy, you can find yourself getting sued for a lot more money than you are worth. So at the end of the day, you do just need to be cognizant about the risk factors in life in general, and plan appropriately and be smart about that. On the side of behavioral items, and this is where I kind of say I don't think this is as common as people think it is, but it's what people jump to when they think about bankruptcy. If it's a person who genuinely overspends on credit cards, who can't control their spending, who took out a HELOC on their house to buy something stupid, no offense, or borrowed money for, like from a 401k to buy something stupid, no offense, right? Like whatever it is, at the end of the day, what you've demonstrated is that you have a lifestyle that is more substantial or more expensive than your income can afford. And there is no solution for that except right sizing your lifestyle, period. There's no budget strategy or anything that will fix that beyond spending less than you earn. Right. And so then in that sense, if we're trying to prevent bankruptcy, very obvious things: don't spend money you don't have on credit cards. Make sure you pay off your cards every single month before you accrue any interest. Don't take out loans for dumb toys. Like, all these various basic like things that I think everybody listening instinctively knows. And then realizing and recognizing that building strong credit gives you access to lower cost forms of credit when you need it. Right. And I use the word need, not want, in such a way that it can actually improve your life quite dramatically to have a good credit score, to have multiple credit cards, etc., as long as you can manage them responsibly. But if you have failed to do that in the past can become precursor to present. We want to be very mindful that just because we've gotten ourselves out of trouble maybe once before doesn't mean that we've necessarily gained the lifelong skills to stay out of trouble indefinitely. So it's just being very honest with yourself. Not here to pass judgment, not here to say that you got to go to therapy or do something crazy, but really fundamentally just being very honest with how responsible you are in your day-to-day life with your money, and whether borrowing money or taking on debt is a responsible decision on your part, or whether it is probable to ruin your life.
Well, more good life advice by Dan. Well, that's always good.
Never had anything but. All right. Well, if that answers your questions on bankruptcy, then I think I get to ask you a very thoughtful, deep, provoking question this week, which is, you have been here as of this Friday for 2 years. You've been working in the financial planning field for just shy of 2 years at this point. So I'll ask you, what have you learned in the last couple of weeks you think is beneficial for people to think about? But I'll broaden it out and say, what have you learned in the last 2 years that you think is really beneficial for people to know or think about?
Okay, so that first short-term one that we kind of do every week. Yesterday actually, I had a conversation with a wonderful couple that came in just kind of like for a consult, kind of get to know what our services are and everything. And they had this excellent communication system for like their budgeting and how they spend their money in the household and savings rates and fund money. They talked about it forever. They're very excited. And it was so fun to listen to them talking about it and see the impacts of them having done this for years and years and years. She was able to retire slightly early, and now he's looking at doing the same thing. And they seem to be in a very good position. And it was so fun to see the end result of this advice we're always giving people, which I think we've done in the podcast many times, which is talk to your partner about spending and what works for your household, And they found a system that worked really, really well for them, and they've stuck to it, and they've been super diligent, and they were so excited about it. And they're, now they're reaping the reward of that, actually. And that was so fun to talk to those people yesterday. So that's a little short-term answer of what I've learned recently. If I had to step back and look over 2 years, I don't know. That's kind of a bigger answer. There's lots of things about it hasn't been what I expected, which I know sounds very cliche and whatever, and I've said this in other podcast episodes, but I've been very pleased to discover that personal finance is in fact incredibly personal, and I get to talk to people all the time. I think that's really fun. As far as making progress in like education and learning and all that, starting from square one to where I am now, I have found that just repetition and determination is a lot more important. I know you and I had a conversation, I think a few months ago, about something else entirely, but I said, I think it's so important if someone is just very, very determined. I don't think that everyone I've met who's incredibly successful is super talented or very lucky or even necessarily very intelligent, but they're very determined. Every successful person I've ever interacted with is just very determined and like diligent. And I have found that to be quite true in the last 2 years, even if maybe I don't want to finish the class that I'm in or finish reading the book that you have assigned me or stay late to do whatever it may be. But actually, it's very much so benefited me to remain diligent and learn a lot. And now I feel much farther ahead than I think I thought I would be after being in the industry this long, which is nice for me because I set pretty high bar for myself. I'm kind of hard on myself when it comes to accomplishments. So overall, it's been fun. That's my long rambling thing. You have to be super determined and communicate about your budget to your partner. 2 parts.
All great advice. The Science of Wealth is produced by My Wealth Planners, a registered investment advisor in Colorado. The theme song is This Is Your Time by Dan Phillips. The podcast is intended for educational purposes only and is not investment advice or any other form of advice. Not all material discussed on the podcast is appropriate for every individual in every circumstance, so you should consult with a certified financial planner, tax professional, or legal professional as appropriate before attempting to apply any of the subjects, strategies, or tactics discussed on the podcast.